40 harsh investing truths. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this blog post from Stockify discussing 40 harsh truths I wish someone told me before I started my investing career. Now I read through these and I thought, you know what? This would be great to share and discuss to see if people agree or disagree with these 40 harsh truths. So let's get right into it. So number one, the market doesn't care how much you paid for a stock or what you think a fair value is. Like I always say, the idea of fair, it's for children. It's for children. It's not, it shouldn't even be said to parents or to adults. You know, the whole idea of fairness. Life isn't fair. Number two, saying, I'll be greedy when the others are fearful is much easier than actually doing it when the opportunity arises. I think that's right on the money there. It's easy to say that you'll be greedy when others are fearful, but it can be difficult to go against the herd and everything that's being pushed out there. 3. Most of what is taught about investing in school is theoretical nonsense. There are very few rich professors. I saw that when I was studying economics. I thought it was quite interesting. They were telling us, yeah, economists are terrible investors. They're terrible in business. A lot of them, they don't actually, they're not good with money. And that was shocking to me. But it makes a lot of sense now. 4. Being emotionally detached from your stocks will save you from a lot of blunders. Now, I'm seeing that just in certain cryptos. People are just so attached to it. We're seeing it with the GameStop. People are they're doing it completely from just a revenge perspective or to try and stick it to the man, and they're just going to burn away their money for absolutely no benefit. None at all. Number 5. It's hard to time markets. Small investors tend to be pessimistic and optimistic precisely at the wrong times. Predicting the short-term direction of the stock market is futile. The long-term returns from stocks are relatively predictable. What do you think, everyone? That sounds like a lot of sense. It is difficult to time the market. 6. A 20% loss only requires a 25% gain to get back to even. But a 50% loss requires a 100% gain, and a 90% loss requires an astonishing 900% gain just to get back to even. Now, I experienced a 90% loss in one of the crypto ICOs I invested in. It was one Scott Adams was pushing forward. And I'm going, we're never going to make the return on this thing. So I liquefied it and used the cash, what little I had left. But it shows you, yeah, just holding with diamond hands is going to be a nightmare. There's some people that have made 100% loss or a 90% loss on GME. 7. Several famous investors, whom we call legends, have barely beaten an index fund over their careers. In the stock market, huge wealth is not necessarily indicative of big returns. And this is why, one of the reasons why, well, not an index fund, but managed fund is what Ramsey's always putting forward. If you get an ETF that just tracks the market, maybe. 8. During recessions, elections, and Federal Reserve policy meetings, a lot of people turn economists and become unshakably certain about things they know nothing about. I think we can all agree with that, particularly when we see it in the media. 9. The more comfortable an investment feels, the more likely you are to be crushed. Don't know about that. What do you think about that one? 10. Instead of trading derivatives, intraday trading, or penny stocks, just light your money on fire. Statistically, he's right there. 11. The gap between a great company and a great investment can be miles apart. Well, yeah, the stock market is all on psychology, isn't it? And perception and, predictions or expectations, not reality. We're seeing that with all the IPOs that are for companies that are making absolutely nothing, that are going gangbusters. Don't worry if you don't understand a big bank's balance sheet. The people running it and their accountants don't know either. There will be 7 to 10 recessions over the next 100 years. Don't act surprised when they come. The more someone is on TV, the less likely his or her predictions are to come true. I wonder what do you think about that one? So for everyone that's Peter Schiff isn't on TV anymore, does that mean his predictions will come true now? 15. 30 years ago, there was 1 hour of market TV per day. Today, there are upwards of 18 hours. What changed isn't the volume of news, but the volume of nonsense. 16. Professional investors have better information and faster computers than most people. You will never beat them in short-term trading. Don't even try. 17. How much experience a money manager has doesn't tell you much. You can underperform the market for an entire career. 18. The majority of market news is not only useless but also harmful to your financial health. As Mark Twain said about truth, a lie can travel halfway around the world while truth is putting on its shoes. 19. Not a single person in the world can predict what the market will do in the short run. Thus stop trying to predict the nifty movement or believe in someone who claims to do the same. 20. Professional investing is one of the hardest careers to succeed at, but it has low barriers to entry and requires no credentials. That creates masses of experts who have no idea what they're doing. 21. Most IPOs will burn your money. People with more information than you have want to sell. Think about that. 22. When someone claims to get rich quick schemes based on charts, moving averages, head and shoulder patterns, or resistance levels, walk away. 23. The phrase double dip recession was mentioned 10.8 million times in 2010 and 2011 according to Google. It never came. There were virtually no mentions of financial collapse in 2006 and 2007. It did come. That's a very interesting insight, isn't it? The low-cost index fund is one of the most useful financial inventions in history. Boring but beautiful. What do you reckon? The most boring companies, toothpaste, food, and bolts, can make some of the best long-term investments. The most innovative, some of the worst. Yeah. 26. Investments that offer little upside and big downsides outnumber those with the opposite characteristics at least 10 to 1. 27. Marty Whitman says about information, rarely do more than 3 or 4 variables really count. Everything else is noise. 28. 30 years from now, the Nifty 50 will look nothing like it does today. Companies die and new ones emerge. Unless you're in the Australian housing market and the government won't let you die. It feels like it. 29. The real interest rate on 20-year treasuries is negative, and investors are ploughing money into them. Fear can be a much stronger force than arithmetic. 30. Make a brain tattoo of the Buffett quote about progress. First come the innovators, then come the imitators, then come the idiots. 31. The next recession is never like the last one. Well, we're seeing that now, aren't we? 32. The best investors in the world have more of an edge in psychology than in finance. 33. What markets do day to day is overwhelmingly driven by random chance. Attributing explanations to short-term moves or discussing them is like trying to explain lottery numbers. 34. If you have any kind of debt and you are thinking about investing in anything, please stop. Get that debt snowball attack going first, guys. 35. In this business, if you're respectable, you're right 6 out of 10 times. You're never going to be right 9 out of 10 times. 36. There is virtually no accountability in the financial gurus camp who come on TV. People have been wrong about everything for years, still drawing crowds. 37. Just high income will not make you wealthy. Saving and spending responsibly will. That's right. I did a survey asking people what you thought was considered a good income and what would be wealthy. You can be on 6 figures, you can be on even $500,000 a year and still feel like you're poor. We saw that in all the articles about the professionals who were dependent on the mortgage holidays to stay in their home. Well, because they'd overborrowed and they were living a life beyond their means. Isn't the trick to earn more money, but to still live frugally so you can then build a money-making machine so you don't have to work for all your money? Isn't that the goal that we should aspire to, rather than be expected to just give our money away to super funds so they can do it on our behalf? Maybe that's why our financial literacy is declining as a country. 38. The next time is never like the last time. And 39. Time is much more valuable than money. 40. 39, I think that's really important. 40. In expert tennis, 80% of the points are won, while in amateur tennis, 80% are lost. The same is true for wrestling, chess, and investing. Beginners should focus on avoiding mistakes, experts on making great moves. So there we have it. What do you think, everyone, from Stockify? 40 harsh investing truths. Do you agree with them? Do you disagree? Let us know in the comments down below. And what would be some investing truths you would give to people who are considering getting into it? As always, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. You can also use SelfWealth, where we get 5 free share trades, and you get 5 free share trades if you sign up using our referral link. Take care, guys. Have a great day, and I will see you all next time. Bye for now.